Picture this. You've just taken what feels like the perfect trade. The setup looks clean, your entry is sharp, and price is moving in your direction. You relax in your chair thinking, this is it. This one's going to pay. But then, without warning, the market spikes the other way. Your stop is hit in seconds. You sit there in disbelief, staring at the screen. And here's the kicker. Right after you're out, the market reverses again and goes exactly where you thought it would. You're not just frustrated. You feel hunted, like someone is watching your trades. If you've ever experienced that, you've just witnessed the hidden truth about liquidity sweeps. And here's the shocking part. It's not an accident. It's not bad luck. It's not random. It's how the market is designed. I'll never forget the night I finally understood this. I had been trading for months, losing again and again in the exact same way. Price would tag me out by a few pips, then run in my direction without me. I thought I was cursed. But then, one night, I cleared my charts of every indicator and just watched price move. What I saw changed everything. Over and over again, price would hunt above a high or below a low, take stops, and then reverse. It wasn't chaos, it was a pattern, a trap, a liquidity sweep, and that's when it hit me. The market isn't hunting me specifically, it's hunting liquidity. And liquidity sits where traders put their stops, above highs, below lows, around obvious support and resistance. The market needs liquidity to move, and the easiest way to get it is to trick retail traders into thinking the breakout is real, only to sweep them out before the true direction begins. Here's the hidden truth most traders never learn. Liquidity sweeps are not noise. They're not accidents. They're signals. They're the footprints of institutions. And once you know how to read them, you stop being the prey and start trading alongside the hunters. Let me make this real with a story. A trader in my Discord, named Daniel, used to rage every time his stop was hit by a wick. He thought the market was rigged against him. But when I showed him liquidity sweeps, how price often hunts a level before moving in the real direction, it clicked. The very next week, he caught USD sweeping the Asian session low, then reversing up during London Open. Instead of getting trapped, he entered after the sweep and rode the move for a 1-5 risk to reward. That trade didn't just give him profit, it gave him perspective. This is why I say liquidity sweeps are the hidden truth, because once you see them, you can't unsee them. Every chart, every pair, every day, the market plays this game. And if you're not aware of it, you'll keep falling into the trap. In this video, I'm going to pull back the curtain. I'll show you exactly what liquidity sweeps are, why they happen, where to spot them, and how to trade them step by step. By the end, you'll stop asking, why do I always get stopped out right before the move? And start saying, I see the trap before it happens. But before we break it down, I want you to sit with this thought. The market is not random. Every wick, every spike, every stop hunt has a purpose. And once you learn to read that purpose, you move from being a victim of the game to playing it like the professionals. And remember, you don't have to figure this out alone. In my Discord, we spot liquidity sweeps together every day. Traders post charts, mark levels, and call out traps in real time. It's like having a team of eyes watching the market with you, making sure you never get blindsided again. So as we close this first chapter, I want you to think back to your own trades. How many times have you been stopped out, only to watch the market go in your favor right after? How many times have you blamed yourself, when in reality, you were just caught in a liquidity sweep? Those moments weren't failure. They were lessons. And now you're about to learn the truth behind them. In the next chapter, I'll break down the anatomy of a liquidity sweep, step by step. You'll see exactly how they form, how to identify them in real time, and why they repeat over and over again across every market. Once you see the structure, the trap will never catch you the same way again. Imagine watching the market like a movie you've seen before. You know the script, you know the twist, but the characters on screen, the retail traders, don't. They think it's a breakout. They think it's safe. They think they've got the move figured out. But you, with new eyes, can see what's about to happen. You know the sweep is coming to understand liquidity sweeps. You need to see the pattern step by step. It's not random. It's a sequence, a dance that plays out every day across Forex, stocks, indices, and crypto. Step 1, the buildup. Price consolidates in a range. It could be the Asian session range on Forex, a simple sideways box before New York opens, or a pause after a big move. This is where the market builds up energy. And while traders think nothing is happening, institutions are quietly positioning. Retail traders place stops above the highs and below the lows of this range, convinced that the breakout will give them direction. Step 2, the fake breakout. This is the trap. Price pushes out of the range, often with speed, convincing everyone that the breakout is real. Buy stops above resistance are triggered. Sell stops below support are triggered. Traders jump in aggressively, thinking they've caught the start of the trend. But in reality, this is the market collecting liquidity. Step 3, the sweep. Once enough liquidity has been taken, once retail is trapped, the market reverses sharply. This is the sweep itself. Stops are cleared, positions are flipped, and suddenly everyone who thought they were right is wrong. Step 4, the true move. After the sweep, the market reveals its real direction. Often, it moves hard and clean, because with liquidity collected, institutions now have the orders they need to drive price where they want it to go. This is the move you want to catch. Now let me give you a real story. A trader in my Discord named Victor used to love breakout trading. Every time the market broke a level, he'd jump in, and every time he'd get faked out. He thought he was unlucky. But when I showed him this anatomy, the build-up, the fake breakout, the sweep, the true move, his whole perspective changed. The next week, he watched USD JPY build a tight Asian range, break upward into London Open, sweep the high, and then collapse downward. Instead of buying the breakout like he used to, he sold the reversal after the sweep. That trade ran for hundreds of pips, and he said to me afterward, "It felt like I finally understood the game." The beauty of this pattern is its consistency. It doesn't matter if you're trading EUR and USD or Bitcoin, the anatomy repeats, because human behavior repeats. Retail keeps placing stops in the same places, and institutions keep exploiting that. Another example. On NAS 100, the market formed a morning range. Price spiked below the low, triggering sell stops, then instantly reversed upward. That was the sweep. The real move was bullish, and it lasted the entire New York session. Traders who understood the anatomy caught the ride. Those who didn't were left wondering why the breakout failed. This is why understanding liquidity sweeps is like having X-ray vision. You stop seeing breakouts as random. You stop blaming yourself when your stops get hit. You start seeing the sequence: build up, fake breakout, sweep, true move. But here's where it gets even more interesting. Not all sweeps are the same. Some are shallow, just a quick wick past a high. Others are deep, dragging traders far into the trap before reversing. The trick is learning to recognize both and staying calm while they unfold. Because once you know the anatomy, you don't panic when the sweep happens. You wait for it, and here's the best part. Once you know what to look for, you realize the market gives you this pattern almost every day. You don't need 10 strategies. You don't need to guess. You just need to spot the sweep, confirm the reversal, and trade the true move in the next chapter. I'll go deeper. We'll talk about where liquidity sweeps happen most often, the exact places on the chart where institutions love to run stops. Because once you know the hot spots, you'll stop being surprised and start anticipating the trap before it even happens. Think about this. If you were hunting for fish, you wouldn't throw your net randomly into the ocean. You'd go to the places where fish always gather. The reefs, the shallows, the places they can't resist. The market is the same. Institutions don't hunt liquidity at random. They know exactly where traders keep placing their stops. And if you learn those hotspots, you'll stop being surprised when price spikes into them and start anticipating the move before it happens. So, where do liquidity sweeps happen most often? The first hotspot is yesterday's high and low. These are magnets. Every trader, whether beginner or advanced, watches these levels. Breakout traders set buy stops above the high, sell stops below the low. Swing traders hide stops just behind them. That makes them gold mines of liquidity. When price approaches these levels, don't blindly buy or sell the breakout. Expect a sweep. Expect the market to run the level, clear the stops, and then decide its true direction. The second hotspot is session highs and lows. In Forex, that's the Asian session range before London and New York open. In indices, it could be the pre-market range before the stock exchange bell. These session boundaries are favorite hunting grounds. Institutions know traders love to fade the Asian range or chase its breakout. That's why sweeps happen there daily. The third hotspot is obvious swing points. Look at any chart. You'll see a clean high or low where price reversed strongly before. Retail traders love to anchor their stops just beyond these points. If you see a swing high standing alone, expect liquidity sitting above it. If you see a swing low, expect liquidity below. The market loves to tag these areas before moving. The fourth hotspot is equal highs and equal lows. This is where retail sees resistance or support. Price touches the same level 2 or 3 times, and traders get convinced it's strong. They pile up orders there. Institutions know this. Equal highs are like a neon sign saying liquidity above. Equal lows scream liquidity below. And sure enough, the market sweeps them almost every time. The fifth hotspot is imbalance zones. These are areas where price moved too fast, leaving inefficiencies in the chart. Price often comes back to these zones to fill the imbalance, and when it does, liquidity sweeps are common. The market grabs stops before completing the fill. Let me give you a real story to tie this together. A trader in my Discord named Sarah kept losing on breakouts. One morning on GBP USD, she saw London open pushing above the Asian high. She bought the breakout. Within minutes, the market reversed, swept the high, and dropped. She was furious. I told her, that wasn't a failure. That was liquidity. The very next day, she waited for the sweep instead of chasing the breakout. Price ran above the Asian high again, then rejected hard. She sold the reversal and caught a massive drop to New York low. That single trade flipped her mindset forever. Here's the truth. Once you know the hot spots, sweeps stop feeling random. They stop feeling personal. You realize the market is just doing its job, clearing liquidity. And instead of getting trapped, you start preparing for the reversal. Another example. On NAS 100, price formed clean equal highs during New York session. Traders piled in shorts, hiding stops just above. Later that day, the market spiked up, swept the equal highs, then reversed downward. Retail screamed manipulation. But if you knew the hotspot, you weren't surprised. You were ready. This is why marking your chart matters. Every day, draw yesterday's high and low. Draw session ranges. Highlight equal highs and lows. Note imbalance zones. These are the danger zones and opportunity zones rolled into one. Because where liquidity lies, the sweep is likely to follow. And remember, you don't need to do this in isolation. In my Discord, we share hotspot maps daily. Traders post their charts before sessions begin, marking liquidity zones and potential sweeps. That way, you can see in real time how these hotspots play out, and you'll start training your eyes to spot them too. In the next chapter, I'll take you deeper into trading liquidity sweeps with precision, because knowing where they happen is powerful, but turning them into entries with proper stops and targets is where the money is made. That's where you go from watching the game to playing it like a professional. E-trap before it even happens. Now that you know what liquidity sweeps are and where they happen, the next question is simple. How do you trade them? Because spotting the sweep is one thing, but turning it into consistent profit requires precision. And this is where most traders fail. They either jump in too early, or they miss the move completely because they're scared. The trick is to learn the rhythm of the sweep and wait for confirmation before pulling the trigger. Let's break it down. Step by step. Step 1. Identify the hotspot. You already know where sweeps happen most often. Yesterday's high and low, session ranges, equal highs and lows, obvious swing points. Your job before the trading session even begins is to mark these levels on your chart. Think of them as tripwires. If price touches or sweeps them, your attention sharpens. Step 2. Wait for the sweep. This is where patience comes in. A sweep means price breaks the level, grabs liquidity, and then shows rejection. Don't confuse a clean breakout with a sweep. If price breaks a level and just keeps going, that's not your trade. You want to see a fake out. The push through the level, stops triggered, and then signs of reversal. Step 3. Confirmation of reversal. This is the most important part. Don't just guess that a sweep will reverse. Wait for proof. On the smaller time frames, that proof often looks like a sharp rejection wick, a strong engulfing candle in the opposite direction, or a break of intraday structure. That's your signal that the sweep has completed and the true move is beginning. Step 4. Entry. Once confirmation comes, you enter in the direction of the reversal. If price swept above a high and rejected, you enter short. If it swept below a low and rejected, you enter long. The key is discipline. No entry without confirmation. Step 5. Stop loss. Your stop should always go just beyond the sweep. Why? Because if price comes back and runs the level again, the setup has failed. A tight, logical stop keeps your risk small and your edge sharp. Step 6. Take profit. Aim for the next liquidity pool. If you short after a sweep above yesterday's high, target yesterday's low. If you long after a sweep below the low, target the high. If there's imbalance, target the fill. This way, you're not exiting randomly. You're letting the market guide you to logical levels. Now let me share a story. A trader in my Discord, named Marco, struggled for months with sweeps. He understood them in theory, but always entered too soon. He'd see price sweep a high and immediately short, only to watch the market push higher and stop him out before finally reversing. He was right, but too early. Once he learned to wait for confirmation, that rejection candle, that structure shift, his results flipped. One morning on EUR/USD, he spotted the Asian high sweep during London Open. Instead of shorting immediately, he waited for a strong bearish engulfing on the 5-minute chart. He entered short, stopped just above the sweep, target at the Asian low. The trade ran perfectly. He told me afterward, "Patience saved me more money than any indicator ever did." Another story. On NAS 100 during New York session, price swept below the pre-market low. Retail panicked and sold, but institutions were buying. Price formed a sharp rejection wick, then a bullish engulfing candle. One of our members went long right there, stopped below the sweep, target at the intraday high. The trade paid out beautifully, and the lesson was clear. The sweep is the trap, but the reversal is the trade. Here's what you need to remember. Liquidity sweeps aren't your signal to jump in. They're your signal to get ready. The sweep is the trap being set. The reversal is when you strike. That small shift in mindset will change your trading forever. And one more thing, not every sweep should be traded. Some days the sweep happens, but the market doesn't give a clean reversal. That's okay. No trade is better than a forced trade. This strategy works because it filters noise. If the sweep isn't clean, if the confirmation isn't clear, skip it. The market will give you another chance tomorrow. In my Discord, this is exactly what we do. Every session, traders call out sweeps in real time. We don't enter blindly. We wait for confirmation together, post our entries, stops and targets, and hold each other accountable. That's how you build consistency with this strategy. In the next chapter, I'll show you how to take everything you've learned and turn it into a complete system. From marking your charts, to spotting the sweep, to entering with confirmation, to managing trades like a professional. The blueprint that transforms liquidity sweeps from something that frustrates you into something that funds your account. Imagine this. You sit down at your desk in the morning, charts open, coffee in hand. Instead of feeling lost, instead of chasing every candle, you feel calm. You know exactly what you're waiting for. You know the trap the market is going to set. And when it comes, you don't panic. You don't get tricked. You're ready, because you've built a system around liquidity sweeps. And now the game is finally in your favor. Let's put all the pieces together. Step 1. Preparation. Before the session begins, mark your chart. Yesterday's high and low. The Asian session range. Obvious swing highs and lows. Equal highs and equal lows. These are your hotspots. Think of them like a map. The market will almost always visit one or more of these levels during the day. Step 2. Observation. As price moves into your hotspots, don't trade yet. Watch. Ask yourself, is this a clean breakout, or is this a sweep? Are we seeing signs of liquidity being collected? This is where patience pays off. Step 3. The sweep. Price pushes beyond a key level. Stops are triggered. Traders jump in the wrong way, but you don't. You know this is the trap. You wait for the rejection. A wick, an engulfing candle, a structure shift. That's your proof that the sweep is real. Step 4. Execution. Now you strike. Enter in the opposite direction of the sweep. Stop loss goes just beyond the level. Target goes to the next liquidity pool. Yesterday's high, yesterday's low, or the next clean structure. Logical, simple, repeatable. Step 5. Management. Don't babysit every tick. Let the setup play out. If the sweep was clean and your confirmation was strong, the trade will move. Some will win, some will lose, but your edge is in the repetition. Step 6. Review and refine. After the session, journal your trades. Did you enter too early? Did you wait for confirmation? Was your stop in the right place? This process sharpens your eye and builds discipline. This is the complete liquidity sweep system. Preparation, observation, sweep, execution, management, review. Repeat this enough times, and it becomes second nature. Now let me give you a story of what this looks like when it all comes together. A trader in my Discord named Luis had been struggling with inconsistency for years. He'd win big one week and give it all back the next. When he started learning liquidity sweeps, he finally found structure. He began every day by marking yesterday's highs and lows, the Asian range, and obvious swing points. He waited for sweeps at those levels, entered with confirmation, and targeted the next pool. Within 3 months, his trading had transformed. He wasn't just making money, he was consistent. He told me, for the first time, I feel like I'm trading with the market instead of against it, and that's the truth of this system. It takes you out of the retail mindset of chasing breakouts and puts you in sync with how the market really moves. You're no longer the prey. You're aligned with the hunter. But here's the final key. Discipline. This system only works if you stick to it. Skip preparation and you'll miss the hotspots. Jump in before confirmation and you'll get trapped. Move your stop out of fear and you'll break the logic. The market rewards patience and punishes greed. That's why the system is simple, because the hardest part isn't spotting sweeps. It's controlling yourself long enough to trade them right. And remember, you don't have to do this alone. In my Discord, we trade liquidity sweeps together every day. We share hotspots, call out sweeps in real time, and hold each other accountable. If you want to master this system faster, that's where you'll find the support. So here's your choice as we close this journey. Keep trading blind, keep blaming manipulation, keep falling into the trap. Or take this system, master it, and finally flip the script. The hidden truth about liquidity sweeps is that they're not your enemy. They're your edge. They're the most reliable pattern in the market. And if you learn to trade them step by step, they can change everything. The market will always sweep liquidity. That's how it survives. The only question is, will you keep being the one who gets swept? Or will you be the one waiting on the other side, ready to take the trade?